Singapore's manufacturing activity declined for the fifth consecutive month in January, but despite the drop, the country's latest PMI of 50.7, it still represents a period of continued expansion. A reading above 50, of course, indicates general growth of the manufacturing economy.
The latest data from the Singapore Institute of Purchasing and Materials Management is within analyst expectations. They say it's in line with weak PMI data globally, and growth is also pegged to China's expansion.
Singapore's PMI for January declined 0.4 points from December 2018, which is the lowest reading since December 2016. However, the PMI continued to remain in expansionary mode for 29 consecutive months. This is in contrast with the electronics sector's 49.6 reading, which represents 3 straight months of contraction. Market watchers aren't surprised by the latest set of data, saying it's a protracted global issue.
We are off the peak of a global cyclical upswing, and now the broad investment sentiment, capex, as well as manufacturing activities are undergoing a period of consolidation.
OCBC economist Selina Ling says the dip in the output and import index for the electronics sector indicates a sharper deterioration. It also corresponds to a less favorable business outlook for the next 6 months. As most Asian economies are now in contractionary territory, OCBC noted that if indices were to fall further, it could dampen growth prospects in the region. However, other analysts say that the biggest downside risk is the slowing growth in China.
China and Hong Kong markets contributes to nearly 1/4 of Singapore's overall trade activities, and there's a fast cooling off in Chinese consumer confidence market.
Still, economists estimate Singapore's GDP forecast at 2.2% for the first quarter of 2019, which is in line with official growth forecasts of between 1.5 and 3.5% for 2019.